Hello and welcome. My name is Andy Last. I'm the media manager at Pure Financial Advisors, and thank you for joining us today for Decision 2020, the election and your finances. That's our webinar for the day. I will be managing any questions you have for your presenter today, so type them into the chat box as you think of them throughout the presentation, and he will answer them as he's able. And I'm going to send you a chat message right now so that you can see where that chat function is. Keep in mind that the presentation is live, and you will want to stick with us to the end to make sure that you get all of your questions answered. Now, if you lose connection with us at any time, you'll see there's a little reconnect button at the top of your screen. You can just click that and jump right back into the presentation. Your presenter today will be Brian Perry, CFP CFA. He's the Executive Vice President and Director of Research at Pure Financial Advisors, a financial planning firm headquartered here in Southern California. Pure Financial is entrusted by our clients with over $2 billion in assets under management and was ranked among the top registered investment advisors in the nation in 2020 by RIA Channel and the Financial Times. Now, Brian Perry has been actively involved in the financial markets for more than 20 years as a portfolio manager, strategist, and trader. He is a widely published author, and his newest publications are Ignore the Hype, Financial Strategies Beyond the Media-Driven Mayhem, and Retirement Revamp, Financial Planning in Times of Crisis. Brian has presented at hundreds of seminars and conferences around the country and has appeared frequently in the media, including regular appearances on the TD Ameritrade Network and on Your Money, Your Wealth radio show, podcast, and television show. Now, please welcome your presenter, Brian Perry, CFP CFA. Hello, Brian. How are you today?
I'm awesome, Andy. How are you?
I'm very well. It's good to see you. We haven't done this in, what, a month?
I know. And you'll notice as you see me, and for the audience, there's no blue or red anywhere on me. I was very careful when I dressed this morning. I thought I'd go in blue suit, white shirt, red tie, but then I'd look like I was running for office, which I'm not. So here I am.
Thank you for that. And I didn't even plan it, but I didn't wear any blue or red either. So there you go. So we're set. We're neutral.
Nice. So, yeah, and welcome, everybody. And I want to get this right out front. I am not here to change anybody's opinion on who to vote for. In fact, if at the end of this you've changed your opinion on who to vote for, I would suggest your convictions weren't strong enough in the first place. Because nothing I'm going to say is pro-Trump, pro-Biden, pro-Republican, pro-Democrat. It's all about the way things are, the way things are likely to be, and then what steps you can take in order to navigate what's been a crazy year. I'm gonna quote. Why not? I'll go and quote the Grateful Dead. Right? What a long, strange trip it's been, and 2020 has been nuts, hasn't it? I mean, coming into the year, who would have thought that we would have a year in which we had a pandemic in which people were forced to quarantine in their homes and couldn't go out? I mean, here in Southern California today, they're opening up the playgrounds. It's the first time in 6 months little kids can go to the playground. It's crazy, right? We had a 40% stock market decline followed by an equally sharp rebound. We had the sharpest economic contraction and the swiftest in history. Record-setting levels of unemployment that were 6-7 times higher than anything we had ever seen. Right? Oh, and by the way, there's an election coming up, right? What would have been the headline story in most other years kind of got shifted a little bit to the back burner. We talked about it a little bit early, February, March, right? Would Sanders be nominated? What about Biden? But since then, it kind of flew under the radar. Now here it is front and center. And here's the deal. We have an election on November 3rd. We don't even know if we're going to know who the president is on November 3rd. There's a lot of talk about when will the election actually be decided. And so Andy's got some poll questions. And Andy, why don't you throw one up for me, please, in when do you think the election will actually be decided or we'll know the results officially?
All right, hold on just a second. There we go. When do you think that the final outcome of the election will be known? You'll see that poll on your screen right now. And your options are November 3rd or December of 2021. But, the way things have been going, who knows what is going to happen. So yeah. I'm going to close this up in 5, 4, 3, 2, 1. I'm going to give it a couple of more seconds because I know that people are a little bit slow on the take there to let us know what they think. I'm going to close this poll now. So we have 57% who believe that the election will be decided in December and 42% who think it'll be decided on November 3rd.
Okay. So here's I have no idea, right? But elections prompt enough volatility in the financial markets. There's enough uncertainty when they're actually decided at the time of the vote, right? Imagine what the world is going to be like, what the media is going to be screaming, right? My new book, Ignore the Hype. How much hype and craziness is there going to be in the media if we go a month, a week, 2 months, 6 months without knowing who the next president is. It's going to be insane. How do you think stock markets and financial markets are going to react? Markets hate uncertainty. Talk about uncertainty, especially when we have two candidates as widely divergent as the two that we have. And so let's take a look at what looks like the most likely outcome for the election right now. And we'll run through a few slides here. Let's jump up here. Right, that's me and my smiling mug. You're already seeing who will win in November, right? As a reminder, you need 370 votes, electoral votes, to win the presidency. This is an electoral map put out by CNN with a look at what states are likely to go Republican, which are likely to go Democrat, which are a little bit more uncertain. And as you can see, blue obviously Democrat along with their electoral votes. Biden at the top right now forecast to get 269 electoral votes, tantalizingly close to that 270 he needs to win. Trump, on the other hand, with 169, so at a big disadvantage. And then those yellow, those are the key states. Those are what are known as the battleground states where the outcome could go either way. And now those can change. When I first put this slide together, it was about a month ago, Arizona and Wisconsin were considered battleground states. Pennsylvania was not. Since then, those two states, Arizona and Wisconsin, have leaned more towards the Biden camp where they're likely to go Democrat. However, Pennsylvania's become more of a battleground state to make up for that. But you can see that the electoral math works against Trump or the Republicans in general, in that the Democrats kind of have more solid electoral votes, and then the Republicans are basically trying to win all the swing states and turn a few Democratic states in order to win the election. But again, the map may favor Biden, but you could have said the same thing in 2016 about Hillary Clinton, and yet Trump pulled the rabbit out of the hat then. So we'll see what happens, right? However, things have definitely been going in Biden's favor. So you can see that back in the spring, basically neck and neck. And now Biden with a commanding lead as far as likelihood of winning, 86% to 14%, right? Pretty substantial odds for Biden. The only thing to note, though, is that most of that increase in the lead, most of that gap came about in the late spring and early summer when there was more shut-ins and more quarantines around coronavirus, more social unrest in the United States. As those things have not gone away, but as they've died down or tamped down just a little bit, we've seen the polls kind of steady where Trump is sort of holding his own, maybe inching back into the race a little bit. This is one that's going to come down to the wire, guys. Right? Right now, The Economist, if they take a survey of all the polls out there, give Biden an 86% chance of winning, about 6 and 7. That being said, the biggest impacts on this election are probably going to be the economy and coronavirus, right? Those things are changing by the day, by the moment. I've been doing this since the mid-1990s, and I've never seen a more uncertain year where day by day we don't know what's going to happen with a new vaccine, with restrictions on our daily activities, social distancing, with the economy, people getting back to work. If the virus continues to kind of slow down, if people can go about their lives, if the economy continues to improve, that's going to tremendously help Trump. Of course, vice versa is also true. What about Congress, though, right? Because there's a presidential race, but the president can only do so much if they don't control Congress. So when we look at Congress, right now, where are we? Well, the Senate is controlled by the Republicans. 53 seats in the Senate out of 100 to 45 for the Democrats with a couple of vacancies. The House is Democratic. 232 for the Democrats, 198 for the Republicans. The Libertarian Party gets 1, and then there's 4 vacancies, right? When you look at most projections, most prognosticators feel that the Democrats are going to continue to control the House. Projections vary on exactly how big their lead will be, but the electoral math is not a friend of the Republicans in the House of Representatives this year. Seems very likely the Democrats will continue to run that chamber. So then we shift to the Senate, because right now Congress is divided. To pass legislation, you need both chambers of Congress to pass a substantially similar bill. So obviously, if Biden wins and he controls both parties, that gives him an advantage. If Trump wins and the Republicans somehow control both chambers of Congress, that gives them an advantage. Or you can have a split government like we've had. Opinions vary a little bit more on the Senate. You can see right now that there are 35 seats up for vote this year. Only about a third of the Senate turns over every 2 years because they're 6-year terms. 22 of those seats are Republican, only 13 Democrats. So a little bit of an advantage for the Democrats this year in that they simply don't have as many seats to defend. Also, more of the battleground states happen to be currently held by Republicans. The last forecast I saw projected actually a tie in the Senate by one source. They were projecting the Republicans to lose 4 seats, Democrats to gain 4 seats. and it to be a 49-49 tie. So we'll see what happens there. The biggest opportunity for a sea change in the direction of government is a Biden victory, followed by a Democrat victory in both houses of Congress. Then you get a true blue government. That would probably lead to the most change. And that's what a lot of market prognosticators have been a little bit concerned about. I've heard a lot of people say, oh, well, what if the Democrats sweep? Are they going to destroy the economy? Are taxes going to skyrocket and the like? And again, keeping politics out of it, but there's often this general sense that markets are better under Republicans than Democrats, or Republicans are more business friendly. The reality is that both parties have been in control at various times, right? So you can see here, this looks at the House and the Senate and who's been in control in the last 20 years. You can see there have been times that the Democrats have been in control, times that the Republicans have been in control. There's no pattern. It doesn't work out the way that if the Democrats are in power, things go south, or if the Republicans are in power, things are great. There's a lot going on in the economy, from the Federal Reserve to businesses to interest rates to how the global economy is doing. The government has an impact, but they can't dominate the economy. So the election is important, but exactly how important is it? So the question then becomes, do elections even matter? And let's take a look at some election history, and then we'll open it up to a couple questions, right? So first of all, we're in an election year, 2020. How have markets done in election years, right? I mentioned previously, markets hate uncertainty. How have markets done with the uncertainty of an upcoming election? The reality is, in election years, when a president is up for vote, markets have done pretty well, right? Bonds are in yellow, stocks are in orange, and you can see that in all election years, the market's up about 11% on stocks, 5.5% on bonds. And regardless of whether or not the incumbent wins or a new president's elected, markets have generally posted positive returns. So the track record for election years is not that bad. Okay, check off one concern. What's the second concern? Well, oh my God, what if the wrong candidate gets in there? Are things going to blow up, right? Well, here's returns under different presidential terms going back to 1929. You can see everything from Trump to the two Obamas, the two Bushes, all the way back to Herbert Hoover. And what do you see? Well, for one thing, it was not good to be Herbert Hoover, right? The market fell pretty substantially while he was in office. That was the stock market crash of 1929, followed by the Great Depression. But under almost every other president, with the exception of George W. Bush, who had both the tech bust of the early 2000s and then the financial crisis at the end of his term, under every other president, you've seen positive returns over most of their terms. Blue, red, it hasn't mattered. Markets have generally gone up. Why? Because here's a chart of how markets usually go, right? Over time, markets go higher, right? It's not a straight line. There's lots of wiggles in there, lots of bumps, but over time, markets go higher. And it doesn't matter if you're a Republican, Democrat, Independent, Republican, Democrat, Republican, Democrat, Democrat. There's a lot of upward momentum for markets, right? On our radio show one day, we had, this was about a year ago, we had Jonathan Clements, longtime writer for the Wall Street Journal, and he said that if you believe that life is better today than it was 100 years ago, the reason is because some company has made a product or service that's improved lives. Maybe it's high-speed jets that can take you to, internationally. When we don't have COVID, you can go travel. Maybe it's a cure for polio. Maybe it's FaceTime so that even if you're in quarantine, you can still see the grandkids. There have been these developments that have made life better. Those companies have done well and prospered, and the stock market's gone up. So unless you think that the economy and the world and progress are going to stop, it almost doesn't matter in the long term who the next president is. There's a powerful upward momentum behind markets. If we look more now at, this is just another chart of presidents, but let's shift to Congress, right? Because Congress is the other part of the election puzzle, right? And if we look here, you can see red is Republican-controlled Congress, blue is Democrat, and then anything with the bars is mixed, which is what we have right now. And again, you can see this long upward momentum in markets. But what I really want to point out is look at that big gap between about the mid-50s and the mid-80s, and then again from the early 90s through the 90s, where the Democrats were in control of both houses, and yet those were times of incredible economic prosperity. Similarly, you can see that the Republicans were in control for most of the 2000s, and again, times of economic prosperity for the most part. Markets can do well under each party. Why am I hammering that home? You all have your opinion. Again, I was joking about convictions at the beginning. You all have your preferences for who you want to see elected. I have my own preferences. I'm sure Andy has hers, right? However, it's important to differentiate between the way we want things to be and the way things are likely to be. And what I mean by that is that if who you want to win doesn't get voted, you can't take your ball and go home and give up on investing, or you're not going to meet your financial goals. Let me say that again. If the party or person you want to be elected loses, you can't just avoid investing because you think the world's going to come to an end and still meet your financial goals. You might be right for a week, a month, a year, even a couple of years, but over time that's going to hurt you. Look at this. Here's going back to the early 60s. If you invested $10,000 only under the Republicans, you'd have less than $90,000. If you invested the same $10,000, but you're true blue Democrat, you refuse to invest when those darn red Republicans are in office, you're going to not do it. Well, you only have $375,000. But if you invested under Republicans and Democrats, you'd have $3.25 million, right? That's why you need to stay invested under both parties, because markets have gone up under both parties. I don't have a crystal ball. I don't know what's going to happen after November, but I do know that there's a lot of progress in the economy, in technology, in health, in a lot of areas of life. And if you think life's going to continue to get better, you want to stay invested regardless of what party's in power. Let's answer the question of would Biden raise your taxes? I think that's something on a lot of people's minds. So let's take a summary. Biden hasn't necessarily come out with one kind of crafted tax proposal. So this has been cobbled together. We have in-house CPAs here, and we had them kind of comb through the internet, comb through all the proposals, and put together a summary of some of Biden's main proposals around taxes. So first of all, he wants to restore the top individual tax bracket to 39.6. So a quick reminder of how tax brackets work. Taxes stair step. Right? It's like walking up a set of stairs. There's a 10% bracket currently, a 12, a 22, a 24, a 32, a 35, and a 37. Right? These brackets we have today are the lowest that we've basically ever had. Right? If you look back 3 years, so Trump lowered taxes at the end of 2017 with the Tax Cut and Jobs Act. Before that, we had a 10%, a 12, 22, 24, 32, excuse me, those are these tax brackets. We had a 10, 15, 25, 28, 33, 35, and 39.6. These were also, before 2017, some of the lowest tax brackets in history. Trump went and lowered taxes further. But because there wasn't a supermajority of 60 votes in Congress, these tax cuts aren't permanent that we have right now. In fact, at the end of 2025, taxes are currently scheduled to revert and go back to the higher rates. So if Congress does nothing, taxes are going higher at the end of 2025. One of Biden's current proposals is to immediately get rid of the 37 and make it 39.6. So that would impact the higher earning attendees here in the webinar. The rest of them Biden hasn't specifically addressed yet. There are various candidates in the House and Senate that have proposed either raising taxes back to the old level sooner or potentially even taking them past here and taking them higher. But again, taxes stair step, one of Biden's proposals to raise the top tax bracket. And we'll talk a little bit more about where taxes might go in the long run here in a second. So another one, qualified business income deduction. So what this is this was a step put in place under the Tax Cut and Jobs Act to normalize the tax rate that a sole proprietor or somebody with an S corp would pay as compared to a large corporation on business profits. It also applies to many real estate incomes. Right? The plan or the proposal under Biden is that that would phase out once your income gets over $400,000. Another thing, right now there are two sets of tax brackets. There's the ordinary income brackets, which again, 10, 12, 22, 24, 32, 35, and 37. These are for things like Social Security, a required minimum distribution from an IRA, income you get from work, whether it's a W-2 or a 1099, stuff like that, an annuity. There's also what are known as long-term capital gains. Those rates lay over these ordinary income brackets. If you're in the 10 or the 12% bracket, your long-term capital gains rate is 0. If you're up here at the top, your long-term capital gains rate is 20%. And if you're here in the middle, it's 15%. Right? If your income is over $200,000 single, $250,000 married filing jointly, there can also be a 3.8% surcharge to pay for the Affordable Care Act on any of these rates. Again, one of Biden's proposals, if you're up here in this top tax bracket, rather than getting the special long-term capital gains rate, it would be taxed as ordinary income, which he's proposing to make 39.6. So you can see there an almost a doubling. So let's say that you had a liquidity event. Let's say that you own a business and you sold it under this proposal and you made $2 million from the sale. Right now, under current law, a federal tax rate on that would be 20%. The proposal here would be to double that to basically 40%. Right? In the state of California, for those of you that are in California like I am, there is no long-term capital gains rate. Everything is taxed as ordinary income. So another proposal by Biden is to eliminate the step up in basis. So when you inherit something, you get what's known as a step up in basis. So let's say that your parents bought a house long time ago. It's worth $100,000, and let's say it's a stock. They bought it for $100,000. They sell it for $1 million. They would owe taxes on that stock or that gain of $900,000. Right? However, if they pass away and you inherit it, you get a step up in basis. Your new cost basis, instead of what they paid is what it was worth on the day they died, $1 million, you could turn around and sell it without taxes. Right? So really beneficial to inherit assets that way. Again, another proposal here is to eliminate that step up in basis for individuals making more than $400,000 a year. All right, another proposal, capping the benefit for itemized deductions at 28%. What that means is if you gave a bunch of money to charity right now and you itemized your taxes, you would get a deduction dollar for dollar based on whatever tax bracket you were in. Let's say it was the 32% or 35% bracket. Under this, it would be capped at only 28%. Right now, the way Social Security works, you pay into Social Security. Your award is based on your 35 highest earning years. You pay 6.2% of your income, and then the employer matches 6.2%. If you're self-employed, you pay both, right? Right now, you pay up to $137,000 of income. So if you made $200,000 of income, you'd basically pay Social Security tax the first 8 months of the year or so, and then the last 4 months, you would have hit that $137,000 cap, and you would no longer pay into it. Your benefit is then based on how much you've paid in up to that $137,000. The proposal here, and this was similar, Hillary Clinton proposed something similar 4 years ago, is to hit the 137 and then you get a little bit of a break up to 400. After 400,000, you would once again pay into Social Security at that 6.2% rate. But here's the key takeaway is you would not get any bigger benefit. Your benefit would still be based on paying on 137,000. However, above 400,000, you would continue to pay another 6.2%, but would not get those benefits back in the way of more Social Security down the road. There's a proposal to eliminate certain tax preferences in the real estate industry. And then finally, and this could be a big one, is revising some of the tax deductibility of 401k contributions. And here the idea would be that rather right now, if you put money in a 401k, it lowers your income. They would do away with the tax break, and you would then get a tax credit instead that would be capped in the 26%, right? So instead of, it would help people in lower income brackets, but right now, if let's say you're in the 35% bracket, you get a deduction when you contribute to a 401k of 35%. Under this proposal, that benefit would then be capped at 26% instead of the 35%. So a series of proposals here, not necessarily all of them would become law. I mean, there's a long history of politicians that state a position and then kind of back away from it or moderate it once they get elected. Biden's proposals are more measured than some of the candidates that were running, like maybe a Bernie Sanders or something. But still, a lot of proposals there to increase taxes, particularly on what are considered, at least under these definitions, the wealthy. But let me ask a question of everybody. And Andy, maybe we could put up our second poll question of where do you think taxes are going? Whether it's when Biden gets elected or down the road 5, 10, 15 years from now, where do you think taxes are going? Higher, lower, stay the same?
So that poll is now on screen. You'll see it on the right-hand side. If you are on a desktop computer, it'll be down at the bottom. If you're watching this on your phone, do you think tax rates are going higher, lower, or will not change? And I'll close this one up in 5, 4, 3, 2, 1. I'm going to give it just a few more seconds here. Somebody did not see the last poll before it actually ended, so I'll give it a little more time here. And I'm going to end this poll right now. So right now we are at 95% of our audience believes that the tax rates are going to go higher. 4% say no change.
That I'm impressed. Like, we need to pat ourselves on the back. When's the last time we're talking about the election, right? When's the last time 95% of Americans agreed on anything?
Good point.
You all are unanimous in the fact that your taxes are going higher. There's nothing else you could agree on. Any other political issue we brought up, we'd claw each other's eyes out, but we're all convinced taxes are going higher. I love it, right? Here's why I'd probably be in that camp too, right? Let's look at this next chart. There's a lot of numbers on here, but let me pull this up. This is the U.S. debt clock, and this has a bunch of numbers on it, but what I want to highlight is a couple things. One is, I'm going to circle here the U.S. national debt, $27 trillion, right? That's increased by more than $3 trillion just based on the response to the coronavirus, right? There's nothing wrong with that, right? It's triage. When the patient is dying, you need to do everything you can. The economy hit a complete standstill. Businesses and people needed to be helped. The government spent money as they had to in order to keep the economy going. But the problem is that the debt had been growing for years before that. We have this big debt. How do you pay down a debt? There's 4 ways. You can grow your way out of it. Maybe that would be nice. You can default on the debt. I don't think we're going to default. You can inflate your way out. You can have a little bit higher inflation, pay back with a little bit less valuable dollars. Maybe we have a little bit more inflation. The other thing is you can tax your way out of it, right? Why might we need to tax our way out of it? Look at these 2 numbers. Debt per citizen. This, for all of you on this webinar right now, is how much you owe the government or how much the government owes on your behalf. Each of you look at your personal balance sheet and then add $81,112 for your share of the government's obligation. Congratulations. Let's look at the revenue the government collects per citizen. $9,257, right? I don't know how many accountants or math majors we have out there, but doesn't have to be one to know that that math is not great, right? At some point, if the government were a business, it would be insolvent. If you owe $81,000 per citizen, you're only collecting $9,000 of revenue. Your business model, your revenue is taxes. You need more tax money to pay off that debt. Whether it's in January if Biden gets in office and the Democrats have a sweep of the House and Senate, whether it's in 2025 when tax rates revert back to their prior highs, or whether it's at some future date, it seems very likely taxes are going to go higher. So we'll circle back to that because I think with the election and the associated volatility, you all might have some opportunity to moderate your taxes in the future if you're strategic about it this year. And we'll talk about that more in a second. Let's look at the election proofing the portfolio here. Let me pause actually real quick. Andy, any questions?
Yes, actually, we do have some questions. So let me actually kill this slideshow real quick. A number of questions. Actually, Bill, I wanted to mention he had a comment, just as you said. He said deficits and the economic situations to come dictate that taxes will have to go up no matter who is elected. Matthew says, do you have any current info or insights about the proposed exit tax for people moving out of California?
So what he's referring to is there's a proposal to tax wealth. The one proposal I saw was more than if you had a state worth more than $30 million and you left the state of California, they were going to assign an annual tax, which I think is what he's referring to. I think it was 0.25% of the value of your assets, and it would be assigned for 10 years even if you moved out of California. That's the last update I've seen. I haven't seen any more progress. I've heard more chatter around a tax increase on incomes over $1 million in California being retroactive to the beginning of 2020. I've heard more talk about that than I have about that, what you would call a wealth tax.
Catherine would like to know, is there any indication that the backdoor Roth is going away?
No, not that I've heard. And
Okay.
we'll talk about that, but no, not that I've heard.
Andy would like to know, do you worry that Bernie will be a very different from average Democrat and that the market will be impacted? Now, I guess we could say that, you know, they have said that Bernie will have impact on a Biden presidency, obviously. So what is your take on that?
I don't know. I mean, I think in every party there's a spectrum, and you know, I'm not a political expert, but my sense is that Bernie Sanders is on the left-hand side of the Democratic spectrum, you know, pushing closer towards socialism. I don't know. I mean, how much of an impact does he have? He certainly has followers. He certainly has a core of hardcore supporters. I mean, without getting overly technical, if we had a parliamentary system like they do in the UK, Bernie Sanders and his backers' ability to sort of make legislation or get their views known would be stronger. So a parliamentary system, a niche party like Bernie Sanders backing has more ability to control legislation and outcomes than they do in a two-party system. So I don't know. I mean, will he have some impact? Maybe, but you know, the Democrats ultimately nominated a pretty moderate Democrat. You know, Biden's a well-known entity. He spent 30 some odd years as a senator. He was one of the most senior senators. He spent 8 years in the White House as vice president. He's a pretty known quantity, pretty well known for being middle of the road, give or take. So I would kind of suspect that out of at least the beginning of his term, but who knows?
Ricky says, is there any chance of the Roth being taxed?
I mean, anything's possible, but I haven't heard anything about that. And we'll talk some more about Roths in a minute, but yeah, haven't heard anything about that.
Glenn says, good point that with market increases, life gets better with new products, et cetera, with a commitment to global warming, unemployment, and homelessness, and no world travel. It's obvious that life in the economy is getting worse and likely to do this for 2 years or more. Doesn't that mean the market is likely to fall? So get out of the market for a while like the super rich just did.
Yeah, I mean, a couple things. One is he could certainly be right. The super rich, I mean, there's probably some super rich that have gotten out, some that have gotten in. I don't know. I mean, I think all those same arguments could have been made back in April, and the market's up 60% since then. So, you know, and I've got a slide here at the end of the presentation I'll show, but in general, the worse the news is, the worse the economy is, the worse corporate profits are, the higher unemployment is, the better stock markets historically have done, and that's been the case this year. So I don't necessarily have a crystal ball. I don't think that, look, guys, I think we're gonna have volatility. The fact that the stock market went, basically for several years, there was some volatility. Stock market came up, and then it absolutely collapsed from record highs. And then it came straight back up, and now it's going like this, kind of. I think we're in for more volatility, right? We don't have a vaccine yet for COVID. Even when we do, you need to get everybody to take the vaccine. You need to get herd immunity. You've got long-term economic damage from people that maybe their jobs have gone away, they've been displaced. Maybe they've leveraged up their personal balance sheet with debt on home equity or a credit card to stay afloat until they can get back to work. You have people whose behaviors are forever changed that are going to be more hesitant to do some things. I think this is a sea shift in which, you know, if we went from zero to here kind of thing because of COVID, as far as our behaviors, we're not going back to the way we were. We'll go part of the way back. Life will normalize, but it'll be a new normal. That has economic impacts. I think we'll continue to have volatility, whether because of COVID, whether because of the election, whether because of whatever else we're not talking about today. Right? Things are going to be volatile, but I don't think it's all doom and gloom either. I think it's about figuring out what is your right mix of investments. How much stocks do you have? How much real estate? How much safety and bonds and the like? What mix do you have? And then finding something you can live with for good times or bad.
I think we've got one more question on the political side of the segment. Sylvia would like to know, what would you expect if Kamala Harris becomes president?
I honestly, I don't know, and I'm honestly not qualified to answer that. I mean, that would have to anticipate, you know, Biden first getting elected and then dying in office, and I haven't necessarily given that much thought to it. So I'll kind of respectfully pass on that question.
All right.
So let's slide back into to some slides here and go through kind of how to election-proof your portfolio. And I want to start with a reminder that Hillary Clinton was universally expected, or almost universally expected, to win the 2016 election. And the prevailing wisdom was that if Trump pulled a surprise, markets were going to collapse. And for those of you that can remember back then, markets did collapse. They collapsed for about 15 minutes. The Dow fell like 700 points overnight in futures trading in London before rebounding. And if we look at this slide here, roughly speaking, this is where Trump was elected, right? So everybody knew that Clinton was going to win, and everybody knew that if Trump was going to get elected, the market would collapse, and yet everybody was wrong. Markets had a pretty good run, right? They had a pretty sharp decline here in 2018, but a pretty good run. Then you've got COVID with the sharp decline, but overall, the S&P 500 is up about 60% since Trump was elected. So a really good run for markets over the last 3 years. So there's a lot of events that people sometimes anticipate will cause one thing in the market, and the outcome is often very different. One of the things that we have seen over the last several years as far as markets going higher, though, is that U.S. markets have done quite a bit better than international markets. And so on this slide, anytime you see green, that means that the U.S. is doing better. And anytime you see red, it means international markets are doing better. And so you can see that it was pretty balanced, long stretches of one or the other doing better. The U.S. has dominated here in the last 6, 7, 8 years. Here's the reason why. The reason why is twofold. One is the U.S. dollar has been strong, which helps. The second is that the companies that have been driving the stock market are domiciled in the U.S., and it's basically a handful of companies. It's companies you've heard of: Facebook, Apple, Google, Netflix, Amazon, Microsoft, the FANG stocks, right? This chart here shows the FANG stocks. You can see it in blue going straight up. The yellow is international stocks, right, which haven't done as well as the U.S. But that red line, That's the S&P 500 if you take out the 6 FANG stocks. The other 494 stocks in the S&P in the last 5 years have basically done exactly what international stocks have done. The market's been entirely driven by these companies. I could cite statistic after statistic, right? Apple at one point here in the last couple months was worth more than the entire Russell 2000, right? So you can have a choice. You can either buy Apple and its future earnings, or you could buy the 2,000 other publicly traded companies in the US and their future earnings. The 6 stocks I mentioned here were worth more than all the stocks in Japan at one point, right? So these are great companies. They should be large holdings in everybody's portfolio, but one thing you should all do is examine how much weighting you have to them, right? You want exposure to these companies. They're extremely profitable, great companies, but maybe you don't want too much exposure. So it's about analyzing that, making sure that you're comfortable, because things can change, right? A lot on this slide, but look at the left-hand column here, top left. This is Amazon, and you can see that it's been a great company for decades, but it's only recently that it started to go straight up. And then you can see down here, bottom left, Apple. Great company, right? But it took it 40 years, 35 years to add $700 billion in value. It then took it 5 months here to add the next $700 billion in value, right? Here's, as another example, GE over a 30-year period. You can see similar chart, up, 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 and then in the 90s it went straight up. At this point, GE was the biggest company in the world and the most well-respected company in the world. I'm not saying anything about what's going to happen with Apple or Amazon, but here's GE's stock chart in the last 20 years. You can see that it was up around, what is that, 60 and down in single digits. So just because a company has done great doesn't mean that it's always going to do great. And I just want to throw out that cautionary reminder. Anytime market performance gets concentrated in a handful of stocks, you want to be very careful about how much you own in those stocks. Doesn't mean you want to avoid them. You just want to monitor your exposure. I mentioned bad news and good results, right? Look at this. At the top here, this is the unemployment rate, above 6%, below 4.3, or anywhere in between. Then GDP, that's economic growth in the US. Above 6, at the bottom there is 0.8 and below, and then anything in the middle. And then earnings on the S&P, you can see the strongest above 14, very weak, and in between. And what you see is that the stock market historically, if you go back in the last 70 years, has done the best when unemployment is the highest, GDP, economic growth, is the weakest, and earnings are the worst, right? I think that bears repeating because we're in an uncertain environment, but historically stocks have done the best when things are the worst. We saw that this year. Markets collapsed. The future was bleak. We were locked in our houses, yet we embarked on a tremendous rally. Here's the deal, guys. Like, there's a bunch of things going on right now, right? We have this election coming up. We got COVID. We have an election coming up. The world is crazy. This is the time to control what you can control and be strategic with some things. And I think that there are some opportunities right now that you should be looking at around taxes. And you can take some of the volatility we've seen with COVID, some of the volatility that we might see with the election, and be tactical about something that you should have a strategy for ever, and that's minimizing your future taxes. Because this is something that COVID, no COVID, election, no election, Biden, Trump, is going to save you money in the long run. So let's look at taxes a little bit more. Okay. So when we talk about taxes, there are 3 different pools of money that you can pull from in retirement. There's a tax-free pool, there's a taxable pool, and there's a tax-deferred pool. Tax-free pool, generally it's a Roth account. Taxable pool might be something like a brokerage account. It could be real estate potentially. It could just be cash. These are generally non-retirement accounts. And then a tax-deferred account is something like an IRA, a 401k, a 403b, other retirement type accounts, right? Each of these is treated very differently. There are rules and restrictions on putting money in and taking money out of a Roth. When you put the money in, you do so with after-tax dollars, so you don't get a tax break, but the money grows tax-free and it comes out at 0. The taxable pool, it's nice because it's very flexible. There are no rules or regulations around how much you can put in, when you can put the money in. You can put in as much as you want, take it out when you want. You do so, you put in after-tax dollars, but those dollars grow tax-deferred. If you don't sell anything, if you don't have any income, there's no taxes. And then when it comes out, depending on how you're invested, you can get a special rate known as the long-term capital gains rate. Could be 0, could be 15, could be as high as 20%. Right? Like I mentioned, there could be a 3.8% surcharge as well. The tax deferred pool, on the other hand, again, rules and restrictions on putting money in. However, the money grows tax deferred. The downside, though, is that when the money comes out, it comes out as ordinary income, which, like we talked about, is anywhere from 10 to 37%. One of the keys to a successful retirement is not just how much money you have, but where that money lies. How much tax diversification do you have? A lot of people we meet have a lot of their money in this tax deferred pool, and the problem is this. Let's say somebody's like, hey, I've got $500,000. I've got $10,000 here, I've got $40,000 here, and I've got $450,000 here. Well, the problem is that that person doesn't have $450,000 because the IRS owns a share. Any of you that have an IRA or 401k are running an investment partnership with the IRS. Every time you make money, they get a slice. If your pie grows, their slice grows, right? They're your biggest fans. And the problem is you start to get handcuffed with restrictions on this around at age 72, you have to take money out with required minimum distributions. So even if you don't need this money, you have to have it forced out starting at age 72, about 4%, and then it goes up every year, right? If you pass away without spending the money, there's no getting away from it. IRD is income in respect to the decedent. Your kids would get hit with the tax. Used to be they could stretch that income out over their lifetime. Now it's forced out over 10 years, right? Finally, if you don't take your R&D when you're supposed to, there's a 50% penalty, one of the most onerous penalties in the tax code. So you want to get some flexibility and some control, particularly if you're one of the 94% of the people, 95% of the people on this call that thinks taxes are going higher, right? So maybe you try to get some money in this tax-free pool. Somebody asked about Roth contributions. You can put $6,000 a year in here. If you're over age 50, you can do a $1,000 catch-up. You need to have earned income, and you need to do this by April 15th. But I think the bigger opportunity right now for many of you is not contributions, it's conversions. It's taking some of the dollars you have down here and moving them into the tax-free pool. Now, when you do that, the downside is this. The downside is that you pay taxes, right? When you do a Roth conversion, you pay taxes. However, if you think taxes are going higher in the future, would you rather pay taxes at a lower rate or at a higher rate? Because again, the government is going to force the money out. They want to buy back their share of the partnership. You will pay taxes. It's just a matter of at what rate. So maybe you consider a conversion. And here's why this is timely, is because the deadline for a conversion is 12/31. If you want to do a conversion, it's December 31st deadline. We're coming up on that. Plus, we have COVID and we have an election, so there's some volatility. So you can be strategic about this. And here's how. Imagine you wanted to do a conversion. You want to move some money from here to here. Let's say that you want to move, let's say that you had 1,000 shares of a mutual fund worth $100. The total there is $10,000, is $100,000. All right? You do that conversion, let's just make it up. Let's say you paid 20% in taxes. Your tax bill is $20,000. However, what happens with volatility is that sometimes markets fall, right? Back in the spring, markets fell 40%. Let's say the market falls 20% with the election. You want to be monitoring this and come up with your strategy for what you want to do and then be tactical about how you implement it. Because let's say the market fell 20%. You've still got 1,000 shares of that mutual fund, but now each share is only worth $80. You do a conversion anyway, and now you're only converting $80,000. 20% tax rate, your taxes are $16,000, right? In either one of these examples, you've converted 1,000 shares. You've taken 1,000 shares of your mutual fund, moved it from down here where every dollar of future growth is going to be taxed at the highest possible rate, moved it up here to the tax-free pool where it's going to grow forever tax-free. You can take it out whenever you want at a zero rate, provided you've held it for 5 years. And if you pass away, your kids get it at zero as well. Right? Oh, and by the way, by being tactical, you've cut your tax bill from $20,000 to $16,000. Right? Strategy and tactics. Or how about in this? In this, the benefit of this pool is that you can get preferential rates. With volatility, we're in one of the most volatile environments I've seen in 25 years of doing this. You can do tax loss harvesting. Let's say you have $100,000, and that's today, right? The election comes. We may not know who the next president is on November 3rd. What do you think the market's going to do if you don't know who the next president is? Maybe this 100 drops to 80, right? Well, then it comes back to 100. What you can do is you can sell when it's at 80 and immediately buy back, right? Because the market's going like this. You want to participate in the upward, but you bought something here, now it's down here. You sell and you immediately buy back. You keep your portfolio similar for the rebound, but you generate a tax loss, which you can use to offset future gains. Take a portion of this taxable pool, turn it into a tax-free slice. Right? So you want to take advantage of this volatility. You want to take advantage of the craziness, right? Crisis equals opportunity. It's an old saying, all right? Here's the deal. We'll take more questions in a minute, but here's the things you should do. You want to, in an environment where we have one of the craziest elections we've ever known, where we might not even know the outcome coming up, when we have COVID, you want to look at your investment portfolio. Look at all your IRAs, your 401ks, your taxable account, whatever you have, look at them together holistically and see what kind of exposures you have, what kind of risk you're taking. Make sure you have a risk level you can live with regardless of volatility around the election, COVID, or anything else. Make sure you're also positioned to get a rate of return that will allow you to meet your goals based on Social Security and other income sources you have. You need to get enough return to not run out of money, but you don't want to take too much risk. Analyze that, right? You also want to look at your current tax situation. What tax bracket are you in right now? Where do your assets lie? What tax bracket are you likely to be in for the remainder of your working years? What tax bracket are you likely to be in when you retire? And finally, what tax bracket are you going to be in when required minimum distributions kick in at age 72? You want to analyze all that and then figure out if it makes sense to move. And if it makes sense to move, you need to do that fast because December 31st is coming up. You need to start positioning things now, taking advantage of any volatility along the way, right? Those are all the things you should do, right? We do free financial assessments for people. So if that's something that you're interested in, if you think that figuring out how much risk you have in your portfolio and whether or not that's going to help you meet your goals, if looking at how your assets are positioned from a tax perspective, whether or not making moves around the election and before December 31st makes sense, there's going to be a free offer Andy's going to put up for a financial assessment. We'll meet with you. We'll gather your information. We'll come up with some ideas around how to reposition assets to save money in taxes, how to navigate election market volatility, right? There's no cost, there's no obligation. It's all the things you should be doing. It's just that you get to spend a couple hours for free with a certified financial planner like myself or my colleagues. We usually charge $250 an hour to do that. We'll do it for free, right? This is our busiest time of year, right? We have 3,000 clients that all are talking to us about this. We need to meet with all of them by the end of the year to reposition their assets. We also already have a couple hundred people in the queue that want to go through these free assessments in order to figure out if some of these strategies make sense for them and the clock is ticking. The election, the end of the year, right? However, since you attended this webinar, I promise you guys, it's tight here. We've got a ton of activity going on. I'll squeeze you all in before the end of the year if you want it. So if you want some help looking at your portfolio, making decisions around Social Security and pensions, figuring out if you have enough money, figuring out what tax rate you might be in the future and whether or not it makes sense to reposition either your contributions or do some conversions, seeing if you have tax loss harvesting opportunities. If you want help with that, we'll get you in by the end of the year if you fill out the free offer for the assessment. Again, there's no cost, no obligation, but you need to do something with this information. I don't think anybody out there can honestly say that their finances haven't changed in the last 9 months. The world is changing faster than ever before. It's been one of the craziest, most volatile years ever. Take advantage. Either talk to somebody else about this, do this yourself, or take us up on a free offer. We'll give you a free assessment. We're not going to pressure you. We're not going to try to sell you anything. We're fiduciaries. We're legally obligated to act in your best interest. But we've got CPAs on staff to help look at this, figure out whether or not you're positioned appropriately to minimize your future taxes and whether or not there are any opportunities for you ahead of what's certain to be one of the most volatile times that we've ever seen around the election and with COVID. With that, let me pause. Andy, what other questions do we have?
We have a number of Roth conversion questions. First, Catherine would like to know, do you have to be retired or 72 or older to do a conversion, or can you do it when you separate from an employer at 50, for example?
Great question, and the answer is somewhere in between. There are no, if your money's in an IRA, there are no restrictions on doing a conversion, okay? The only restriction is how much tax you're willing to pay, right? To do a conversion, to do a contribution to a Roth IRA, there are restrictions. You need to be working, you need to have earned income, and if you're single, your income needs to be below roughly $130,000, and if you're married, it needs to be below roughly $200,000 to be eligible. If not, you need to do a workaround known as a backdoor Roth. We had a question on that earlier. That's a workaround if your income's too high. There are no income limits, though, on doing conversions, and you don't need to be working. You don't need to be over or under 72 to move it out of an IRA. With a 401k specifically, There are some rules. Some plans will allow in-plan conversions. So if your plan has a Roth 401k component, you might be able to do an in-plan conversion from the traditional pre-tax portion over to the Roth portion. If you're over 59 and a half, or if you're over 55 separated from service, you can do an in-service distribution. It's 50 if you're public safety. At that point, you can do an in-service. You can move the money if you need to from a 401k to an IRA and then do the Roth conversion. Again, you want to run a good tax analysis first, figure out what tax bracket you're going to be in the future and see how much you want to convert. Because the goal is not to get all the money out. The goal is just to get enough money out so that your future RMDs don't push you into a higher tax bracket than you otherwise would be, right? You want to figure out what tax bracket you're going to be in, all else being equal, and then figure out how much money you need to get out of your tax deferred accounts to avoid pushing you up into higher taxes. Because what you want is you want to live somewhere up here and pay taxes somewhere down here.
All right, the next question is from Gerardo. Can you do a Roth conversion more than once a year?
Yes, no, absolutely. And again, this is something to be strategic or tactical about, right? Like a lot of clients will, let's say that somebody has unknown income. Maybe it's a business, maybe they're not quite sure, and they, we'll do a tax projection in the beginning of the year. You could do a tax projection in the beginning of the year. Figure out how much you think you want to do and do a portion of it in January, because over time you expect investments to go up. So the sooner you can get tax-free growth, the better. But then later in the year, you dial it in. You run another tax projection November, December, and then do the rest of your conversion. You can also be strategic, right, in the sense when the market falls, right? So let's say you're planning to do a conversion at the end of the year when you know your income, but last March, the stocks are down 40%. Well, maybe that's the time you just get strategic. You do a conversion right away anyway. Maybe you don't go all the way up to the level you thought you were going to, but you do most of it to take advantage, like I talked about, of those depressed values where you can move more shares of stock or mutual fund or ETF for less of a tax bill, right? But the sooner you can get dollars in here, the better, because then you invest this differently, right? You invest each of these accounts differently. Because up here, if you have an account where it's going to grow tax-free, come out tax-free, you're never going to pay taxes, you want maximum growth. Figure out what investment asset classes get the most growth over time, put them in there. Put the more conservative investments in here, and then put stuff you can tax loss harvest down here in the taxable pool.
All right, Bill has two very good questions about Roth conversions. First, are there special considerations in doing a backdoor Roth conversion if you have multiple IRAs?
Yes, there are. If you have, so good question, Bill. If you have, so I mentioned a backdoor Roth. Basically, a backdoor Roth is if you have already have income above the level where you're allowed to make a Roth contribution, you can do a backdoor Roth. So basically, you make an after-tax contribution to an IRA. Anybody is free to make an after-tax contribution. You don't get a tax break, but you put $6,000 or $7,000, depending on your age, into an IRA, right, without restriction on income. You then immediately convert that IRA contribution up to your Roth account. It's doing in two steps what the IRS won't let you do in one because you make too much money. It's called a backdoor Roth. However, if you have any IRAs, it doesn't matter if it's multiple. If you have any IRAs that have pre-tax dollars, you run into what are known as the pro rata rules. In other words, let's say that you had $93,000 in an IRA in pre-tax dollars, and you want to do a $7,000 backdoor Roth contribution. You put $7,000 of after-tax dollars into an IRA with the intention of converting it. You've already paid taxes on those dollars, but the IRS isn't going to let you isolate that. They're going to say you've got those $7,000 in an IRA plus the $93,000 existing IRA dollars that are pre-tax. So you have a total of 100. And when you move the money over to the Roth, only a percentage, 7% in that case, pro rata is going to be considered after-tax dollars. The rest of those dollars you're going to pay taxes on. So if you have a lot of money in an IRA, pre-tax, you may not be able to do a backdoor Roth. But then there are other strategies around that where maybe you look at rolling the IRA into your company retirement account or something like that. So there are always strategies and tactics around it, but you want to be consider that for sure.
All right, Bill's second question was, in your example of moving from pre-tax to Roth, assumed mutual fund shares, which would save taxes if there was a market drop. What if you are currently out of the market during volatility and you are in a money market as a temp holding space? Is it still smart to move it?
Yeah, very well, could be. It's the strategy. I keep using the word strategy and tactics interchangeably, but the reality is the strategy is how should you position your assets to have flexibility in retirement around your taxes and control of your tax bracket, right? That's the strategy. If that calls for Roth conversions, you want to do it regardless of what investment is down here. The tactic is from a timing perspective, if you had, let's say, a stock or a mutual fund and it fell in value, maybe all else being equal, you accelerate the timing of the conversion. But just because you're in cash doesn't do away with the idea that if it makes sense to move from a future tax perspective, you would still want to do it. But once you've moved the money up here, you probably want to invest it differently. You probably don't want to do that and then keep cash up in the Roth account. You probably want to invest that again in small company value stocks or emerging market stocks or something with high expected returns over time.
Glenn says, if you convert 401k to Roth, do you need to let that money sit in the Roth before you spend it? I think Brian said it must sit for 5 years in the Roth.
Yeah, so when there's something called a 5-year clock. When money goes into a Roth, there's a 5-year clock. The dollars you put in, so if those are dollars you've converted or contributed, they're your dollars, you've paid taxes. As long as you're 59 and a half, you can take them out at any time with no penalty or taxes. However, any gains on those dollars have to sit in the account for 5 years before you can take them out. Technically, there is a clock for every conversion, but the reality is if you have dollars in here, it's hard for the IRS to disaggregate what gains are on what contribution, but you do want to be sensitive. And that's why this December 31st deadline is so important, because it's a calendar year. So the IRS doesn't care if you opened up a Roth and put money in it in January or in December. Either way, if you get dollars in here in 2020, your 5-year clock will begin in 2020, will be one of the years, so that down the road you can take money out penalty free.
All righty. And then Richard says, when working, you can only invest $7,000 a year in a Roth. Doing a Roth conversion, there is no limit?
Correct. So you can invest $7,000 in a Roth IRA if you have earned income. If your retirement plan allows for Roth contributions, you could do up to the limit there, which is, depending on how old you are, $19,000 or $26,000. However, for conversions, there is no limit. So yeah, you can convert away, but again, you want to be sensitive to how much you want to pay in tax and whether or not it makes sense.
Okay, Bobby has a question, and I'm not sure if he's talking about a TD Ameritrade IRA or a tax-deferred IRA. He says, can you do a Roth conversion from a TD IRA?
If the question's TD Ameritrade, sure, you can do it from pretty much any custodian. All IRAs are in the tax-deferred, so yeah, you can convert from that, yes. So either way, the answer should be yes.
All right, excellent. That is all the questions so far that we have on the Roth IRAs. We have a couple of general investing questions. Would you like to pivot to those?
Sure, yeah, we can keep going. And I want to be respectful of everybody's time, so I know we're coming up against the hour. Again, do something with this information. You took an hour of your time, do something. Figure out what kind of exposures you have in your portfolio and whether or not those are going to help you meet your goals with enough risk and not too much risk. Figure out your cash flow in retirement, whether or not you have enough, how much you can spend. Figure out where your assets lie and whether or not repositioning assets makes sense before the end of the year, right? Again, those are things you should do. If you want us for free to take a look at it, we'll do the free financial assessment. Sign up for the offer. Again, we're jammed going into the end of the year, but we'll get you all in before the election or before December 31st. We'll get you the information you need in order to reposition assets before December 31st. We've got, like I said, thousands of clients, a big backlog of people that want to do the financial assessment, but we'll get everybody in and we'll get you this information if that's something that you want to have us or a CFP take a look at this stuff. But either way, do something with it, because this is something you can control. You can't control the outcome of the election. You can't control financial markets, COVID, volatility. You can control your future taxes.
All right, real quick question on taxes going up. Sheila says, regarding timing, let's try that again. Even if Biden were elected, the Tax Cuts and Job Act tax rates will still be in place until the end of 2025. Biden couldn't change that, right?
No, he absolutely could if he wanted to. He couldn't change it unilaterally. Congress would have to change it, right? So those, absent an act of Congress, those tax cuts expire at the end of 2025, rates go back to where they were. Congress can change the law at any point. Right now, we've got split Congress, right? Senate and Republican, or Senate's Republican, Democrats have the House, and then Republican in the White House. If you get Biden with a clean sweep of Congress, and they so wanted, they could change the tax rates to anything they want. I mean, they could bring them down to 0, which I doubt is going to happen. They could bring them up to 100%. They could do anything they want if they can get it through both houses of Congress.
Andy's question, how to decide if low fee should decide on investment selection. For example, there are ETFs that are over the last 10 years have 20% annual growth and a 1% fee, and another that has 10% growth and 0.01% fee. How do you decide? Great
question. Right tool for the right job. I think I always try to differentiate price and value kind of thing, right? I mean, it's like, I don't know, if I'm going to the doctor and I needed heart surgery, I want to go to the best doctor, and I want him to use the best scalpel and the best anesthesia and stuff like that, right? And then if there's a choice between two equally good, whatever scalpels, maybe I go for the cheaper one. But I don't know, if there's an investment that's going to accomplish what you want and is perfect for the job, I think that's what you use. But that being said, there's a lot of studies and a lot of information that show that one of the key components of investment returns is fees. So in general, and this is just a rule of thumb, in general, very high price investments don't necessarily perform better. The fees act as a drag. So low fees are good, but you don't have to go to the lowest fees. You just want to be sensible about it, save money where you can, and then if there's an area where it's worth paying up for something that's better, then you pay up in that instance.
All right, I think we've got time for one more question, and it comes from Jared. If your current lifestyle is to spend $120,000 a year, what is a good amount to plan for retirement?
As far as how much you need, well, here's how you do it. I mean, this might take a second, but right, how you figure out if you have enough money for retirement, and this is back of the envelope. What you really want to do is map out income, expenses, inflation, taxes year by year, calculate investment returns, and really run a detailed spreadsheet with some well thought out assumptions. But back of the envelope is if you need $120,000 today, I'm just going to assume that you're retiring, whatever, in a couple of years. Let's say by the time you retire, you want to apply a rate of inflation. Maybe you need $130,000, right, just to make that up. So that's how much you need. You then look at your fixed income sources. Let's say you had $30,000 from Social Security and $20,000 from a pension or a rental or something like that, or real estate, right? You look at your fixed income sources, you back them out from how much you need, and the remainder, in this case, $80,000, that's what you need your accumulated investments and portfolio to generate. Rough rule of thumb is that you can take about 4% of your accumulated investments each year from a portfolio. So you would take $80,000, you would divide it by 4%, and if my math is correct, that means you would need $2 million. Right? So in this example, if you needed $120,000 today, but by the time you retire, inflation was going to turn into $130,000, you'd look at your fixed income sources, and if you had, let's say, 30 in Social Security, 20 from a pension or real estate, that would leave 80 that the portfolio would need to support. So whatever the portfolio needs to support, you can kind of divide that by 4%, alternatively multiply it by 25. In this case, it gets you $2 million. It's called the 4% rule. It's a rule of thumb that says that's how much of your assets you can draw down without running out of money, and it allows you to account for inflation and taxes and the like. Opinions vary, right? I mean, some people, depending on when you retire, what kind of investment returns you can get, you might be able to spend 5%. With interest rates really low like they are right now, maybe it's 3 or 3.5. So, but somewhere in that range, that's a back of the envelope way to figure out how much money you need.
All right, I'm going to put a slide up here that's going to show people how they can get in touch with you and how they can schedule their free assessment. And I can't get both of us on screen, so I'm going to go ahead and get off screen.
Yeah,
Brian,
no worries.
thank you very much for this presentation today, and thank you for all of our attendees for attending.
Great. Yeah, everybody, good luck. Don't forget to vote. It's a privilege, and to be able to vote, we're lucky to be able to do it, despite the fact that sometimes politics feels like a circus or worse, but we're lucky to be able to do it. And good luck with that, and good luck navigating. I mean, guys, I think it's going to be one of the more volatile periods we've seen. It's been a crazy year, and I don't see any way that between an election with two candidates that are really polar opposites and constituents that more or less disagree on everything with each other, and then with the fact that we might not know who actually wins the election on election day, not to mention COVID in the background, buckle up for volatility. And if you want to do something about it, again, contact us. We'll give you a free assessment. But if not, do something with this information. Dive into it. Figure stuff out, because the world is crazy. You want to control the things you can control. With that, thank you, everybody, and stay safe and healthy. Take care.